Let's continue on here. We're going to talk with Ed in Philadelphia. Ed, you're with Allworth Money Matters.
Yes, thanks for letting me call in.
Thank you.
I have a question for you guys. I am retired. I got, I believe, more money than I need for retirement. And most of my income from retirement is in dividends. I have an IRA, a traditional IRA that's worth over $500,000. My question for you two is, I have a lot of money, I believe a lot of money, sitting in my checking account at the end of the year. And for the last 30 years, I've been reinvesting most of that back into the dividend-paying stocks. And my tax bill is getting pretty big.
How old are you, Ed?
I'm 63.
Are you married?
Yes.
And how much do you have in stock? And what's your stock portfolio value that are paying these dividends?
Just under $9 million.
And you only have $500,000 in your IRA.
Yes.
And why dividend stocks? Just out of curiosity.
I've been infatuated with dividends ever since I was like a teenager.
It's worked for you.
Oh, they have. They have.
Yeah. I'm not going to try to get you changed on that one. It's clearly worked for you.
And what's the problem?
Yeah.
My problem is at the end of the year, when I'm done paying all the bills and the taxes and everything, I still have a lot of money, I believe too much money, sitting in my checking account. And for the last 40-some years, I've been taking a lot of what's left over at the end of the year and putting it back into the dividends to reinvest into the dividends. But my tax bill now is getting to be pretty big.
Well, if I gave you a solution, you're not going to like it. I'm going to tell you that you should quit buying dividend-paying stocks.
And do what? Just leave them.
How about buy some stocks that don't pay dividends?
Buy
some
stocks
growth stocks.
Some growth stocks.
My guess is that your portfolio is highly tilted towards value companies. You could just buy an index.
You're not managing this portfolio in a tax-efficient manner.
No.
Not even. There's been no attention paid to the tax efficiency of your portfolio. None. Because I would make the argument that you should have 50% of your portfolio in non-dividend paying stocks. And the reason behind that is obviously for current taxations, also because at death, not appreciated assets under current law receive a full step up in basis.
So you can avoid the tax.
Completely. So I appreciate the fact that you've got that this investment philosophy has worked for you. It would have worked for you if the portfolio been growth stocks as well. In fact, it would have worked better.
How much do you have in the check? How much do you have in cash?
Right now, right now I got about 90,000.
Ah, well, that's not bad.
No.
Have you started gifting? You have children?
Yes.
Have you started gifting to them?
Yes.
And the maximum
you give them
amount?
Stocks?
I give them money right out of my checking account.
Are they in a lower tax bracket than you?
Yes.
Why not give them stocks?
I'd give them stocks.
Never thought about that. Okay.
Well, you did call a show.
Idea.
you did call a financial show to get an idea of something that you're not doing, right? So what happens?
Yes.
Here's the reality. If you came into our office today, we would look at this portfolio, and the first thing we do is we'd look at the allocation. My guess is Scott's is it's
highly
mostly
allocated towards value stocks.
and large cap value would be my guess. Large cap value. So we'd look at the portfolio, and the first thing we do is say, okay, where are there risks in the asset allocation itself? Well, if I had a square with 9 different squares inside of it, yours would be mostly concentrated in the top left hand. We'd say, let's try to actually mimic more of what the market is, which is growth, mid cap, small cap. Then after we said, okay, this is really how it should look, how can we build this so it's as tax efficient as possible?
And I'd use a direct index on technology on this.
That's right.
You build a synthetic index and it's managed for tax. You do some tax loss harvesting.
That's right. And so what happens is that, and by the way, if some of these terms are new to the listeners or yourself, it's because they weren't around 10 years ago.
3 years ago.
And the reason they weren't around is the cost of friction, which is the cost of trading, was oftentimes more expensive.
Now it
costs nothing.
Yeah.
So that what we call friction was the cost of buying and selling. And the other thing is that we use technology today that didn't exist 5 years ago. Certainly didn't exist 10 years ago. We use that to actually manage portfolios. So, technology in the investment advisory world has changed. It's the democratization of investments by the use of technology. It brings private office type services to the middle class or the high net worth, which you wouldn't be ultra high net worth, but you'd be considered a high net worth client. So what you're doing, and you're probably doing all of this yourself, correct?
Correct.
And you probably don't want to turn this on to anyone else. My advice to you is you're missing out on technologies.
Oh, not only that, I mean, so we mentioned one idea. You're gifting your children. That's an easy one. Just gift stocks now, appreciated ones. They're in a lower tax bracket. They could probably have, if they plan it right, they have no capital gains when they sell it. But you also might say, maybe we take some portion of this and use a charitable remainder trust and get a nice big tax deduction from that today with a guaranteed income tomorrow. And we can do, as we do that, the tax deduction, we can turn around and sell some of the existing stocks that we have now, encourage the capital gain. I mean, realize the capital gain, but have them wash out each other. And then we can invest in something that's much more tax efficient. I mean, you got a lot of options here in front of you, but it would mean moving a little bit away from having
large
100%
cap value.
Yeah, large cap value, which is what you're invested in.
And I do have a lot of growth stocks in the IRA.
Which, by the way, is exactly opposite.
Mm-hmm.
You've got it completely
opposite.
You've got it completely wrong. Like if I said, let's make this tax efficient, I'm like, let's call Ed. Or let's lose tax efficiency in this portfolio. Let's call Ed. Because your growth stock should be in the IRA and the dividend.
Your dividend should be in the IRA.
Excuse me, the dividend should be in the IRA and the growth stock should be in the brokerage account.
And I think look, Ed, you've done a great job.
You've got a great saver.
Good saver. This has worked for you, right? But it's at a point now you've created a new problem for yourself, and it's the taxation of this, right? Because you've got, you probably got, depending on what kind of dividend stocks, you might have $400,000 coming on, you have to pay taxes on each year. And dividends, right?
A little bit more. Yeah, a little bit more than that, yeah.
Which tells us it's even worse than we suspected in terms of large cap value. Right?
And here's what I would do. You're my brother. I'd say, hey, Ed, go interview 2 qualified financial advisors, certified financial planners. Go meet with 2 different ones and just hear what they have to say. Hear about their ideas. And if one resonates with you, just say, look, why don't you do a financial plan? Pay for them to do a financial plan that they can come up with all these strategies to show you the impact it could have on you financially.
The money you would actually save in taxation would more than pay for the cost of professional asset management on this account.
Okay.
That's a promise.
Oh, yeah, for sure.
I mean, they can manage this account for what? 0.5% and cut your tax bill in half.
Yeah.
Promise.
Right.
Promise.
That's good. I'm glad I called.
Well, I'm glad you are too. And by the way, you've done well. So
Listen, if you did nothing,
you're still going to be fine.
You're still going to be fine.
That's right.
You did
I'm
nothing.
not worried. I'm not worried about outliving my money. I'm worried about what I called in about is my tax bill is huge.
Yeah. Well, I get it. And
You have to take a different approach than the approach that you're taking today. And you truly, you could get this tax bill.
You might choose to take some of your stocks each year and put them in a donor advised fund that you can dole out to some charities in the future.
And you may actually choose to actually accelerate how you're actually giving this the money to the children and use up part of your unified credit.
Yeah.
Right?
Okay.
I mean, no one says that you can't go in and give the kids $1 million today, because you can. It's just less money that you could pass on at your death.